What if I told you that just $100 a month could quietly turn into a massive financial advantage over time? Not through trading. Not through risky bets. And not through some get-rich-quick strategy. But through a simple rule that many successful investors follow. Yet most people completely ignore. And the surprising part? This rule works even if you're not an expert in investing. Stay with me until the end, because once you understand this rule, you might start seeing money in a completely different way. But before we continue, if you're interested in building smarter financial habits and understanding how money really works, consider subscribing to this channel. Here we break down investing, wealth building, and financial ideas in a simple and practical way. Now let's get back to the rule. Most people think investing requires thousands of dollars. They think you need to wait until you're earning more money, or until the market feels safe. But history shows something very different. Many long-term investors didn't start with huge amounts. They started with small, consistent investments. And that's where the $100 investing rule comes in. The rule is simple. Instead of waiting for the perfect moment, you invest a fixed amount regularly. For example, $100 every month. No guessing the market. No chasing hype. Just consistency. Now here's where things become interesting. Let's imagine two people. Person A starts investing $100 every month at age 25. Person B starts investing the same amount, but at age 35. Everything else is identical. Same investment. Same returns. Same discipline. But person A has one massive advantage. Time. Those extra 10 years of compounding can dramatically change the final outcome. And the difference can be surprisingly large. This is why investors often say, time in the market can matter more than timing the market. Quick question for you. At what age do you think people should start investing? 20s? 30s? Or later? Let me know your thoughts in the comments. I'd love to see what you think. Another reason the $100 rule works is something called dollar cost averaging. Instead of investing all your money at once, you invest small amounts regularly. That means sometimes you buy when prices are higher, and sometimes when prices are lower. Over time, this approach helps smooth out market fluctuations. It removes the pressure of trying to predict what the market will do next. And for many long-term investors, that simplicity becomes a powerful advantage. If you're finding this explanation helpful so far, take a second to hit the like button. But the most powerful part of the $100 rule is actually psychological. Once someone builds the habit of investing every month, their relationship with money begins to change. Instead of asking, "What should I spend this money on?" they start asking, "How can this money grow?" And that mindset shift alone can change financial decisions for decades. It helps more people discover videos like this and supports the channel. If you're interested in learning more about investing, passive income, and building long-term assets, make sure to subscribe and turn on notifications so you don't miss future videos. So the real secret behind the $100 rule isn't the number itself. It's the habit. Small actions repeated consistently over long periods can produce powerful results. Many people ignore this rule because it looks small. But in the world of investing, small habits can create surprisingly large outcomes over time. If you enjoyed this video and want to continue learning how money and investing really work, check out the next video on the channel. It breaks down another simple financial principle that many beginners overlook. Stay in touch for more information.